Hello, and welcome to this special GCV webinar. Today, we're going to be talking about COVID-19 and the support for portfolio companies that is being made available by governments and other institutions around the world, a very timely topic for the corporate investment community. And today, we're going to have our founder and editor-in-chief, James Mawson, moderate a little panel with three guest speakers, which I'm delighted to welcome here. We have David Hayes, Chief Investment Officer at BP Ventures, and Mark Radcliffe, Senior Partner at DLA Piper, and his colleague Matthew Bernstein, or Mac, partner at DLA Piper as well. So really delighted to have the three of you here. Jim, also welcome.
Yeah, delighted. Thanks very much, Callahan, for setting this up. And welcome, Mark, David, Mac.
Thanks, Jim.
All right. Alrighty. So before we go on with the webinar, in the presentation that the DLA Piper folks have prepared for today, I like to take really a few minutes to remind people watching this, whether live or subsequently over YouTube or whatever the case might be, that we are currently running a survey. It's a very, very quick survey of just several questions. It shouldn't take you more than really a minute to complete. And we are trying to find out what is the overall impact on the finances of corporate ventures by the COVID-19 pandemic that we're all experiencing right now. So I just wanted to share some preliminary results from the few questions that we've got in that survey real quick. So one of the questions is, are you changing your investment strategies in light of the pandemic? And as you can see, about half of respondents say that it's either yes or most likely they will change it. Similarly, to the question, do you expect to have more or less capital to deploy? We do see that 33% or 1/3 say that they expect to have less. Slightly more than a third expect to have the same amount, and only 11 expect to have a little more. And then we also asked the question, are you having capital withheld internally? And this is the sort of distribution of answers that you can see. For nearly 40% say no, but more than a third say either yes or potentially they will. So the purpose of this survey is also to see if we could set up a networking group in order to explore alternative funding models during a potential downturn. So if you answer yes to this question you see on your screens now, we will contact you and try to make you part of that group. So make sure you do take the survey. A link to the survey is provided to the people attending live somewhere on the right-hand side panel that appears on your screens in the question section, or actually in the chat section, excuse me. And in the questions section, you can feel free to submit your questions, which Jim and our guest speakers will try to answer later on during the presentation. So please feel free to take our survey. It won't take long. With that, over to you, Jim, for a few words on our organization, our digital forum, and then on to the good stuff, the presentation for today.
Wonderful. Well, thank you so much, Callahan. I really appreciate the sort of hard work that goes into preparing for these types of webinars, particularly from our guest speakers, but also from you and others within the team. As most people know, I think Global Corporate Ventures is a trade paper. We help understand which corporations invest in what startups. That might be directly or indirectly as a limited partner and venture capital fund, and how it affects and relates to the overall innovation tool set that a lot of corporations have. That's one of the publications we do. We also look at how universities and governments are engaged with the entrepreneurial ecosystem in similar ways and supporting student and faculty startups and spin-outs, or particularly using mission-led financing structures to help hopefully make the world a better place through sustainable development goals. So Global Corporate Venturing, as well as doing a sort of trade paper, has a leadership society, a membership organization, and then it uses the GCV Connect tool as an algorithm to help make sure the corporations can talk more, and in particular, and highly relevant for today's session, make sure that their portfolio companies are supported. So in terms of their 5 primary needs, if you think about entrepreneurs, she's broadly looking for capital, customers, product development, hiring, and an exit. And I think once we go through the discussion, we'll really get a sense of how the large corporations and the corporate venturing units are supporting and joining with what the governments are trying to do to make sure that we all come through this crisis as well as we can, and also economically do as well as we can. So next slide, please, Kelly. As well as doing some real life events, which at the moment are on hold, where our GCV symposium has been pushed back from the 3rd and 4th of June to mid-October. We will be running in its stead a virtual conference, which we're calling the GCV Digital Forum on the 3rd and 4th in its place. And that will bring together the entrepreneurs and from portfolio companies, as well as the corporate venturing leaders, for a 2-day session with a lot of interactivity and workshops. Next slide. Now we'll be on to the exciting panel. So I'll invite David, Mark and Mac to just give a little bit more of a background about themselves, to provide a bit of context about BP Ventures, and David, your role as Chief Investment Officer there, and then obviously Mark and Mac from sort of DLA Piper, sort of some of the work we've been doing, and then that will allow us to go into the initial conversation. We'll ask Mac to start off with some of the slides and presentation to give some context about how governments are trying to support through this. But David, I'll invite you first to just give a little bit of a framework about yourself and BP Ventures.
Sure, thanks Jim, thanks Kelly for setting this up, and thanks for inviting me along. So yeah, David Hayes, I'm both the Chief Investment Officer for BP Ventures globally and the Managing Director for BP Ventures in the Americas. For those of you who don't know us, we're the corporate venture capital arm of BP. We've been active since around 2007. We've invested around $700 million to date. I would say 300 of that is probably in the last 2 years. So the pace of investing at BP Ventures is absolutely increasing. We're a lot broader than most would think in terms of where we invest. Clearly in support of conventional energy, but in a much broader frame, essentially wherever we can deploy technology or participate in a material way in the value chain and commercialization of that technology. We're about 16 people globally. We've got offices in Houston, San Francisco, Singapore, Shanghai, and London. And my boss is a member of the GCV Leadership Society. So reason for being here, really, you know, the majority of our portfolio is in the US and facing tough times through COVID-19, as well as through the oil price crash right now. And so PPP has essentially been occupying my time and the team's time for the last 10 days or so as we've grappled with the various issues that it's raised. So yeah, I'm happy to be here and be part of the conversation.
Okay, thanks very much. Mark, do you want to sort of provide a little bit of context both about yourselves and DLA Piper is probably the world's largest law?
Sure. Why don't I start out? Although we're not exactly the world's largest law firm. There are a couple that are bigger, but we like to think we're the best. So for those of you not familiar with DLA, we're a global law firm with 4,200 lawyers in over 40 countries. We're focused on enterprise, and we work with startups, not just in the United States, but also throughout the world, from China to Japan to Australia to Germany to the UK. We have teams that work with startups there and also with corporate VCs. I got involved in the corporate venture capital world back in 2001, and we've been able to grow our team, so we now have 9 partners in the US who are actively involved in the corporate venture capital world, and we represent companies from across the spectrum. We also have a training course, which is now online for best practice for board members and board observers, as well as having a training course on term sheets, which is sadly not online. But DLA has a wide range of specialties, and Mac is going to demonstrate the advantage of that, because as the world and startups become larger and go global, their legal needs become quite complex. So I've been doing this for over 30 years, and that complexity has just increased. And obviously now we have startups that are unicorns, which frankly look a lot like public companies, except that they're still private. So what I'd like to do is turn it over to Mac, who's going to talk, first of all, about our federal and regulatory practice, and then in more detail about his practice, in particular, and how it's playing out in this new world of COVID-19. So.
Thank you, Mark. As Mark said, I'm Mac Bernstein. I'm a partner in what we call the Federal Law and Policy Group in Washington, D.C. As part of DLA, we have a very integrated structure and we seek to avoid any siloing, but not surprisingly, a bulk of our federal regulatory policy capability and direct advocacy capability on public policy, which includes lobbying, is focused primarily in Washington, although we're active in multiple states as well. In our practice, we have at least 60 full-time lawyers and senior professionals who come out of government and have many different areas of expertise across the spectrum, from substantive regulatory areas. We have particularly strong financial services and government contracts issues, which are relevant to these discussions. And then we have a very large lobbying practice, although really it's mostly made up of subject matter experts who are recognized as reliable sources by policymakers and help clients interact with policymakers throughout the policy development process, but also in the implementation and follow-through stage. And that's actually kind of a segue to how we've been approaching the COVID-19 crisis from a public policy standpoint in Washington. As I'm sure you are all aware, the CARES Act, which is the largest chunk of federal assistance funding and programming, is not the only legislation that Congress passed in the course of the last month. They actually passed 3 separate bills. Obviously, the CARES Act is by far the largest at $2 trillion, but so many of the programs required an enormous amount of technical expertise that we were weighing in on during the legislative drafting phase, but with enormous amounts of support from technical experts, particularly from the government contracts, corporate and finance spaces within the firm, who were dealing with the everyday issues of how individuals and businesses were being impacted, and therefore how public help could be structured to be most effective. I will say that given the speed with which the legislation was enacted, they did pretty well, but I'm sure you all know, and we can talk about a little bit as we go, there's still enormous imperfections in the legislation that led to lots of slowdowns and bottlenecks, and that has had practical consequences for businesses and individuals. Well, we can talk about those issues a little bit more as we go, but Jim, should we go into the presentation? Yes, so that we can do a quick overview and then do some questions?
That would be perfect, Mac. Thanks for that overview. Thanks, Mark, and thanks, David. Kellyanne, if you want to roll through to the next slide, and then Mac and Mark, perhaps if you want to just give some of the sort of the highlights in terms of this federal stimulus programs. I think we'll come through to the Main Street Loans program a little bit later, but if you want to sort of start off with the PPP piece and some of the broader issues around that front. Mac, Take it from
That
there.
would be terrific. Thank you very much. And as was said, this presentation is far more detailed than what we'll dwell on in the initial discussion, but certainly we can refer back, and we wanted to make sure that you all had a more comprehensive document that might still generate questions, but that might be a resource for you as you go on. This slide is really designed just to provide a very high-level overview of the major portions of the CARES Act, which, as we said, was a $2 trillion bill that was passed on March 27th after about a week of consideration in Congress, which is record time and noteworthy because the federal deficit was tripled literally in the matter of 1 week. The major components of it are about a quarter going to state and local governments and public health institutions to provide direct responses to the COVID crisis. There was about a quarter, a little over, that went to individuals, largely in the form of enhanced unemployment benefits, which in the United States have been sort of the critical bridge for a lot of the individuals who are directly affected and have lost work as a result, unlike in Europe, where there's a slightly different system, which actually US policymakers are starting to look at as possibly an alternative going forward. There was some support for the education sector, but most of that was really for individuals seeking to alleviate the impact of student loan debt, which was already in a very hot button issue in the United States, but made the more so because of the COVID crisis. Notably, that was not very much, at least there were a few bits and pieces, but most of that was not assistance to educational institutions, which is one of the gaps that actually is looked at by many and an area that might receive some attention in future legislation. The $500 billion for big corporations is something that altogether is called the Economic Stabilization Fund, which is very similar to the Troubled Asset Relief Program passed after the financial crisis in 2008, with a couple of significant differences. Number one is it's not mandatory as the TARP was for so many of those institutions. Number two, it does have some of the same kind of limitations on the use of funds and the behavior of the recipients of those funds, particularly the issuance of dividends, bonuses, executive compensation, and perhaps most importantly for many, the preservation of the U.S. Employee base and not shipping jobs abroad. But the main focus of our presentation has, and most of the work that we've been doing lately has been focused on the PPP program, which was a $377 billion program located, but really layered on top of existing Small Business Administration Authority that already has numerous loan programs. The idea of policymakers was that they would layer this on top of an existing structure, and that would streamline the process, which is true to some extent, but I think as we've all seen, the capacity of the institutions that were given this responsibility really was a bit overwhelmed. Why don't we go to the next slide? The couple of key things about the PPP program that I think probably most of you know. As I said, it was layered on top of the 7A SBA program, which has led to some confusion because there are implementing regulations for that program, which are really designed to ensure that funding under regular SBA loans go to true small businesses. And that's what's given rise to what are called the Affiliation Rules, which there's been a lot of talk about. Those are really rules that are SBA specific and are pretty flexible and a little bit amorphous because they were developed really in response to a number of more sophisticated players figuring out various structuring that would allow parts of their enterprises to qualify as small businesses for two purposes. One is to receive assistance directly from the SBA, but even more importantly, it would be to qualify quite often for government set-aside programs that mandate certain portions of various government contracts go to small businesses and certain other qualified businesses. So the affiliation rules are difficult because they're really written for a different circumstance, and in the implementing regulations of the PPP program, there were significant divergences from the standard interpretation of the affiliation rules, which is, on the one hand, has been helpful because it's clarified the eligibility criteria under the program, but at the same time, it's left a lot of gray areas and a lot of confusion and some concern, frankly, because while there's been a focus of the Treasury and SBA in issuing guidance and regulations for the implementation of the PPP loan application process, as well as ways in which the proceeds of PPP loans can be spent, they have not yet issued any formal guidance on what the standards will be for the forgiveness of those loans. And while you can interpret what's likely to be the case, there's no guarantee until those regs come out and the process is clearer that some assumptions about forgiveness from the front end will actually be manifested at the back end. The other major issue is, I'm sure most of you are aware of this, the administration announced last night that the first $349 billion for the PPP program has already been committed, and that there are thousands more applications still in the queue that have not been processed. Now, this was foreseen, and last week there was legislative proposals from the Senate to allocate an additional $250 billion to the program essentially as it is without any modifications. That there was pushback from the House leadership and Democrats in the Senate saying they didn't oppose additional funding for the PPP program, but there were some concerns about the way in which the money was ending up being allocated and whether or not it was going to the areas of greatest need. And certainly the regs and standards were not written to require that. They really were written in order to try to drive money out the door quickly. But there was some pushback on that issue. And in addition, the House was adamant that any further funding for the PPP program be coupled with further funding for states and medical, basically first responders, in an equivalent amount. And that's been bogged down. Now, as of last night, there were ongoing negotiations between congressional leaders to try to find a way to come to a solution and to come up with further funding for the PPP program, but that's still not been resolved. The last thing is that we can talk at the end, as was mentioned, about some of the other programs that might be of interest, whether or not companies are looking to take advantage of the PPP program, again, assuming it's getting further funding. And those are tax provisions, the direct assistance that's available for the Economic Stabilization Fund, but that probably really is only relevant to large companies. And then perhaps something that may become very relevant to many mid-sized to larger companies, this new Main Street loan program that is funded through the CARES Act, but is administered and will be overseen by the Federal Reserve and managed through banks and other lending institutions. Why don't we go forward? We can skip this and go on to the next slide. One of the things that we wanted to highlight is, of course, the PPP program is by far the largest program with eligible entities able to receive loans of up to $10 million to cover essentially 8 weeks of mostly payroll costs, and as well as some other permissible uses like utilities, rent, and mortgage interest. But there are other programs. Now, the Economic Injury Disaster Loan Program is another SBA program that's been in existence for a long time and has typically been used and had money added to it by Congress following natural disasters, mostly hurricanes and floods and the like. And it basically holds that a business that can show that has had total disruption of its business activities as a result of the disaster that's been declared are eligible for relatively short-term loans that do need to be repaid. Under the prior legislation to the CARES Act, it was called the Families First Act, there was a major infusion of funding into that loan program before the PPP program was even considered, and a lot of businesses rushed to that because it was the most immediate source of assistance. There are very strict qualification standards for that. Basically, you have to be an actual small business under Small Business Administration metrics, although some nonprofits can apply as well. The loan duration is relatively short, and there was a maximum of up to $2 million. However, what the data that's been coming out of the SBA indicates that the actual loan amounts that have been made through that program have been much smaller on the range of more like $25,000 a piece. Now that may be in part because there is an advance program under the EDIL program where as soon as you apply, you can basically get a check for $10,000 right off the bat. You definitely have to show eligibility later, but there is an ability to get that immediate infusion of funds. Now, when the PPP program was stood up, they actually took into account that a lot of smaller businesses had already applied for and some had received some EIDL funding. And so there's actually a provision under the PPP to recapitalize some of the EIDL funding and to wrap it into the PPP loan. For most eligible participants, the PPP loan has been much more attractive because the amounts are much greater, although again, the fund is now run out, so we'll see if the EIDL programs see a resurgence. One other very important issue to think about as a business impacted by the situation is there were tax provisions included in the CARES Act that will assist on cash flow issues. So the one that probably has the largest impact, especially for employers with a significant number of employees, is the payroll tax deferral program. And that is essentially that, under US law, employers pay half of an employee's social insurance taxes. The employee pays half, although that's usually through withholding in their wages. And the payroll deferral provision allows for the employer's portion of the payroll tax to be deferred for up to 2 years. It actually needs to be repaid. Half of it needs to be repaid by the end of 2021. The other half by the end of 2022. So there's basically a payroll tax holiday. It does need to be made up that will provide immediate liquidity to any businesses that opt to do this. Now, one of the wrinkles in the PPP program is it said that anyone who receives forgiveness on a PPP loan can't also take the benefits of the payroll tax deferral. That's led to some confusion about how the two programs would interact and what to do while your PPP loan application is pending. The Internal Revenue Service actually just issued some helpful guidance that demonstrate that allows companies to delay their payroll taxes in the hope that if they don't qualify for the PPP, then they can get the full benefit of the payroll tax deferral. And the IRS has said that that's okay and they won't be penalized for doing that. There's a second tax provision that's not on this page, but is detailed later on, called the Employee Retention Tax Credit. It provides under pretty strict eligibility limitations that, again, employers can take a qualified employers can take an immediate tax credit, which is actually refundable against the costs of payroll for certain employees. And that can be a direct infusion of cash. Now, the eligibility requirements limit it to relatively small entities, and there has to be a showing of material reduction in your business as a result of COVID-19 and the like. That is actually something that the Congress is looking at revising to make it more widely applicable so that more employers can take advantage of it and use it as a way to keep employees on their books. The last issue of the payroll, the SBA Express loans, isn't really worth discussing. It will affect only a small number of companies. So let's move on.
Perfect. Well, thank you very much for that, Mac. In terms of, do you want to just give a little bit of a perspective around the PPP, or perhaps we could go into the Q&A and we'll bring out some of the detail through that, and we can pull up some of the slides from there.
So James, I suggest that we talk a little bit about affiliation, just so people have the framework, because I think a lot of the discussion and questions will come around that affiliation issue. So maybe we ought to just move to that slide.
Yeah, I think that would be perfect. I think, that's the issue I'll be interested in from David, from your point of view, as you listen, or as you looked at the rules, but particularly Mac and Mark, if you want to give a perspective about who would be eligible, in terms of, if you're thinking around corporate venturing units and their portfolio companies, what is the complexity of affiliation?
So this is Mark Radcliffe. So just at the top level, I think the key to affiliation is to understand these are general SBA rules that have been in place for some time. And so we're not dealing with things that were specifically designed for PPP. And conceptually, once again, the idea here is to have a truly small business. And I think what I'd like to do is have Matt talk a little bit more about this, and then I can talk about how this has played out in the venture capital landscape. So Matt, maybe you can
Sure. Yeah, and just the one eligibility criteria that everybody talks about is that the program is generally open to companies that have no more than 500 employees or qualify under something called the North American Industrial Code System, with an industry code that would allow for a larger number. For instance, in the manufacturing sector, you can qualify under this with as many as 1,500 employees. But as Mark said, with some exceptions that were made specifically for the restaurant, hotel, and a few others, and for franchises, the general idea is that you look across all of the affiliated entities to determine the number of employees that an enterprise has, and if they come in underneath the number cap, whether it's 500 or under the NAICS code, it could be a little bit higher. That's the key metric to qualification. The affiliation rules, as Mark said, were designed for SBA loans in general, and particularly the 7A program, and are much stricter in some respects in their application to those programs. For instance, revenues matter when you calculate affiliation issues under those different systems. Revenues are not a factor in any of the affiliation analysis for the PPP program. But one of the issues that has come up, and maybe this can be more in the Q&A, is how do you treat the non-US affiliates of an entity? Because the regulations, even though this is not quite what was written in the Act, the regulations implementing the PPP program make it very clear that the employees that matter for counting in terms of your eligibility are those that are principally domiciled in the United States. And under standard SBA affiliation rules analysis, you would actually look at the number of employees globally through all affiliates. But under the language of the Act, it's pretty clear that, or the regs, it's pretty clear that if you have 500 or fewer in the United States, you're fine. If you qualify under one of these other NAICS codes and you're under that number in the United States, you're probably fine as well. Although it does take some analysis and you need to back it up on your applications. However, a number of companies, and in fact, I just heard from one large one this morning, have successfully received loans on the basis that they meet the employee threshold in the United States, despite the fact that they would have many more employees outside the United States that, if counted, would put them over the limit. So, Mark, you want to talk about some of the practical issues?
Sure. Yeah, so the application to the venture industry comes in the degree of control that investors have. And so the risk is that you'll be affiliated, you as a portfolio company will be affiliated with the venture firm, which will then be potentially affiliated with other portfolio companies of that venture firm. In the material, we have the criteria, 50% or more of the voting stock. That would be pretty rare. The part that applies to many traditional venture capital financings, because of the way the structure is, a minority voting control coupled with negative covenants, which are pretty common both in protective provisions and also in the investor rights agreement if you're using standard NVCA forms, the matters requiring investor director approval. And so what has happened is, after understanding that we're not going to get a special exemption, although the National Venture Capital Association has tried for an exception or clarification, and I think they're still trying. Basically people settled into a recognition that if you have somebody who has 20% or more of the voting interest and and there are negative covenants in play, then you need to take a look at those negative covenants, both in the protective provisions and the investor rights agreement, and either amend the agreements or suspend the application, depending on people's appetite for risk, I guess I'd say. But I think that the key here is that we do have a path forward. I think most of the major law firms who work with in the venture field have got a path forward and and have a solution, although you have to analyze each portfolio company on its own. One issue which has popped up, frankly, in another area is the question of venture debt financing, particularly venture debt financing that comes with equity kickers, which is pretty common, and whether those equity kickers raise issues that need to be waived. I know of at least one situation where there's an expert in SBA that is not part of the Silicon Valley ecosystem who's taking the position that they do need to be waived. We're somewhat skeptical about that, but I think the important point here is you need to take a look at not just your equity structure, but also your debt structure. And the other thing that I'm seeing, and I think I'd love to get David's view of this, is a number of investors have now, after basically pushing their portfolio companies to seek out these loans, have suddenly decided, well, wait a minute, there may be prudential reasons not to get the loan. And the prudential reasons are that, as this goes forward, given the amount of money that's in play here, it's guaranteed that the press is going to be basically going over all these applications in great detail, and it would be not too hard to construct a story around why are these venture capital companies funded by these billion-dollar or companies or billion-dollar venture capital firms getting this relief when really it's the restaurant on the corner or the barber shop that should have gotten this relief. And so we are seeing some investors who are saying, well, okay, go ahead and do the application, but we want to have a board approval, not just the application, but we want to have a board approval of the actual taking down a loan. And then if you decide you're gonna go for, basically forgiveness, we want to have board approval of that. And this is really not a legal issue, but it's really more of an optics issue as to how is this going to be perceived after all is said and done. And there are investors who have actually come up with their own sort of rule of thumb, where as board members, they're reluctant to approve even a loan application if you have more than 6 months of runway. So this is a relatively new development that we've only seen like about the past week or so. But David, I'd love to hear about BP's view of this and how and how you guys are looking at it. So.
Yeah, thanks, Mark. Yeah, I mean that's exactly our consideration is the reputational fallout once we're all through this crisis. So I mean we maintain a pretty strict segregation of duties between board members and kind of the shareholder role. So as a group we came together and essentially because BP as a group, as a parent company, has taken the position that BP and its subsidiaries and its associates and joint ventures were not seeking money from a reputational standpoint, it does tend to flow down into a kind of behavior set for the ventures group. So in terms of the US portfolio managers, we've had conversations with each board at the board level around 3 kind of key points. The first being, is any economic hardship that the portfolio company is going through right now specifically related to COVID-19, or is it a more operational technology or otherwise type issue? The second question is the amount of funding available through PPP or otherwise, is it actually material to the runway of the business? And I think this was echoed in an NBCA call I had last week. I think there's a recording online as well. It adds a little bit more information. I think probably worth listening to this and that call. This wasn't really designed to extend runway from 12 months to 13 to 14 months, right? This was really for 2.5 months of runway for these smaller businesses. Really translates to about a month and a half runway for a venture capital backed business in terms of high burn and limited revenue. And so is that material? I mean, if this is getting you from 2 months runway to 3 in order to get a bridge loan in place, I think that's probably fair enough. If this is you do want to raise until 1Q, 4Q next year, but you don't want to push that to 1Q because you think you're going to get a better valuation, that's probably not what this is for. I think that's the sort of second rule around materiality. And then the third piece is just around fundraising in general. I mean, if you were planning on raising equity this year or raising a bridge to a round, then plans should just continue to do that fundraise, and maybe you look to add an extra little bit of money to that fundraise to make up for the shortfall. So that's the conversation we've had at each of the board levels. I think then when you sort of get into a conversation that yes, it is directly related to COVID, yes, it is material to the runway of the business, and no, maybe a fundraise wasn't on the cards. We then get into the conversation around the affiliate rule and whether or not BP would have to take specific action around rights. And there it gets a little bit more complicated, but I will share that the stance that we've taken is that we won't actively enable the access to this capital through the sort of giving up of any of the rights that Mark alluded to. And so what we're doing instead is actually finding ways internally to try and make up that shortfall. Now, we won't be able to provide, forgivable low interest loans, but we can provide funding on very gentle terms, and we're working really hard. I mean, this is a relationship business, right? We're working really hard not only to sort of explain the stance that we're taking as a company, the reputational risk of post this environment and how that could impact the business, but also trying to help out wherever we can. If it's accelerating a bridge, if it's increasing the amount we were going to invest anyway slightly, if there's other ways through the sort of BP parent relationship, whether it's advancce purchase or otherwise commercial terms that can actually alleviate some of the burden. We're trying all that. Our preference would be to not draw down this money in our portfolio companies wherever possible.
That's really helpful. Thank you, David. And obviously, thank you, Mark and Matt, for giving us sort of the overview. In terms of that sort of eligibility then, how many of your portfolio companies do you think, David, that you're seeing, or Mark, given the sort of the wider sweep of venture capital companies that you advise and work with, what sort of proportion do you think would be eligible given those affiliation issues or other optic issues? Do you think this is actually going to be meaningfully helpful for the venture industry and corporate venture industry?
This is Mark. Well, I would say that virtually every company that I represent and every investor that I'm working with is having their portfolio companies to look at it for eligibility. I think that in many cases, if you can get the appropriate, depending on what your cap structure is like, and we've had a couple of companies we've talked to, and it turns out that the affiliation rules won't be a problem for them. They tend to be in the minority. And then it's a question of, okay, if the affiliation rules are applicable and do create a problem for you, can you get a waiver which will be acceptable to people, or a modification of the documents which will be acceptable to people and to the the investors? And then if you can do that, then you get into the prudential question. But but sometimes, and I think David is correct, that people have sort of moved away from the idea of wow, free money to wow, free money, but maybe a big reputational black eye.
That's really
helpful.
So,
so I think a lot. I certainly my advice to my corporate VCs is you need to think first of all, whether you want to proceed forward with this, from a reputational point of view. And we had one company that has about 18 months of runway, and this was back about 3 weeks ago when everybody was running out to apply, who came to us and said, boy, we really don't think this fits, with what you're trying to do, and given the amount of cash you've got on hand, we think that you take a big black eye if you applied and got the money. They decided not to apply. And we also had a recent company where they, it's a small company, sub 10 people. They would have only gotten about a month's extra runway out of it. And after initially thinking about applying, ultimately the board said, no, let's wait. We just don't think the trade-off here, and their business is affected by COVID-19. It was not it was not something that was outside of that. So what I would say is we're seeing a shift from the rush to, let's apply to, should we even think about applying? Is this appropriate for us? Are we going to take a reputational hit, 1 year, 2 years out? So I see that as being a change in the way people are looking at this, and particularly I think as it's become clear that there's going to be no silver bullet, at least not in the near term, on the affiliation rules. Therefore, you're going to have to give up some of your rights. I think David mentioned, there's some investors that are not very enthusiastic about that. So, so I think we've seen a change, particularly in the last week, of the way people view this.
Really helpful. Thank you.
And just to nuance the point I made, I mean, the giving up of rights, it's actually for us, it's less about the rights themselves and giving something up that we feel we negotiated. It's more if our giving up the rights, means an active shareholder step, active participation in the ability to allow the company to access the funds, it's something we're not willing to do. It's less about the rights, it's more about enabling that relationship, that sort of reputational black eye. And in that case, we would much rather see, and look, BP as a company, we're not only battling COVID-19, we're also battling the oil price war, and so the BP Ventures budget is a little tighter than it has been. And yet we are still, our preference would be to try and find the capital and be creative in capital ways than actually allow and enable the access to the cash through PPP.
Very helpful. Thanks, David. Appreciate that. It's useful. And then just Mac, one of the things you started off with was not just the PPP helping the portfolio companies, but there are issues around the parent corporation potentially being bailed out, certainly in some sectors, not obviously oil and gas, but thinking around transport or retail, hospitality, a number of these consumer sectors, where the parent corporation with a CVC are being bailed out, and then the portfolio companies may or may not be able to apply. Are there any issues around, the parent company being bailed out and then what the portfolio can and can't do, or that sort of money being used to support an innovation facility? Are there any optics or practicalities to be aware of from that point of view as well?
So the two things. Number one, the administration certainly is trying to avoid the use of the term bailout for the assistance to the larger players under the Economic Stabilization Fund program, because those are all loan or loan guarantee programs that require both some equity stake be given to the government on a temporary basis during the duration of the loan, but also that they be fully paid back. And that was something under the TARP program that actually proved pretty successful. And in most cases, not every case, but in many, the government actually received a premium on the repayment. So number one, they're trying to frame this not as a bailout, but as a bridge to maintain viability. And certainly sectors like the airline industry are particularly hard hit, sort of a good example of that. And the idea is this happened for reasons that were not their fault, and the employment issues and the economic importance of the sector is so critical that allowing them to flounder would be bad for both employees, but also for the economy in general. So that's number one. So the Economic Stabilization Fund assistance is really looked at as sort of an issue of last resort for companies that really can't find financing anywhere else. And as a consequence, again, the conditions are pretty stark. There are no limitations, however, on a company receiving an economic stabilization loan and receiving other assistance. Now, given the qualification standards under the economic stabilization program, and that I would include the funding for the Main Street Loan Program, there is a need to show that other funds were not readily available, or that you've already accessed other lines of credit and the like. And so the only reason that you might argue that the PPP program, assuming it's refunded, and the Economic Stabilization Program would be mutually exclusive, is if the fact that you were able to get a PPP loan indicated that you hadn't maxed out your available credit. Although nobody's talked about in those ways.
That's very helpful. Okay, thanks, Mac. And then another part, obviously, once you go beyond just the sort of the economic stabilization or the PPP or other sort of loans and issues that could be provided, is what do the portfolio companies think about in terms of furlough and redundancy? And, how does that sort of apply? I know you have some slides, but you might be able to provide just an overview from GLA's point of view about how do these issues potentially sort of overlap in terms of receiving some loans, grants of equity, and or having issues around furlough and redundancy and some of the sort of legal issues around that. And then David, obviously from BP's point of view, what are you seeing on the ground from your portfolio?
Yeah. So very quickly, because I'm not an employment lawyer, and we have our employment team has been extremely helpful in helping companies think through these issues. The term furlough has not been really a term of art in American employment law, although most of us know it from the context of various government shutdowns where federal employees are repeatedly being furloughed while budget negotiations go on. But it is used as a term of art in the CARES Act, And the legal distinction between a furlough and a reduction in force, which is what the employment lawyers call the layoffs, is that during a furlough, while an employee is not permitted to actually do work, and they are not receiving their wages and other monetary compensation, they are generally able to maintain many of their benefits. And for American employees, that's particularly important from a health insurance coverage standpoint. And in fact, for any company with more than 50 employees, for furloughed workers, you are required to maintain their health insurance coverage as well as some other benefits. Now, while on furlough, however, an employee is eligible to collect unemployment insurance benefits, and that's done on a state-by-state basis, and the generosity of those benefits do vary significantly state by state. But one of the provisions of the CARE Act was to add a federal premium on top of every state's unemployment program, so that anyone eligible for unemployment insurance would get an additional $600 a week in federal pay that would flow through the state systems. But in many cases, that is much more than an individual would qualify for in a state on their own. So now you've got unemployment payments that can be as high in many cases as $1,000 a week. Plus, many of the eligibility and waiting requirements have been waived, so that anyone who is unemployed or furloughed can receive those benefits more quickly. In the case of a full-blown reduction in force, the employees or the laid off workers are still eligible for unemployment, and in many cases that's a very positive thing. What they don't get, though, is their benefits, and they aren't necessarily in a position to be recalled by the employer when things return to some degree of normalcy. The very last thing is that for anyone qualifying for or seeking a PPP loan, one of the elements of that is that you maintain your employment levels at least 75% of what they were over the last, you have to maintain 75% of your average monthly payroll based on the prior year, basically. And so while you might be able to work some furloughs into the timing of when you get the loan, that it's something that you need to keep in mind, that you actually have to use, you have to maintain your employment at least 75%, and you have to use 75% of the proceeds of the loan for payroll purposes. But I'll end there.
Thanks.
Yeah, well, and
sorry.
James, just let me mention one thing. Obviously, the rules are quite different when you're talking about layoffs or furloughs in other jurisdictions. And we actually have an entire webinar on how to do reductions in force globally. As a matter of fact, we have a website called the Coronavirus Resource Center, which people can subscribe, and we're putting out a lot of alerts and other information which can be valuable. So if people want to go to the DLA Piper website, which is not surprisingly www.dlapiper.com, just look for that Coronavirus Resource Center. And I think there's a lot of information there too.
Perfect. I've just put it into the sort of chat function, so that's really helpful, Mark, for that. David, anything? I'm mindful we're coming towards the top of the hour, so perhaps we'll sort of finish on this final question. But any thoughts from yourself, David, in terms of the sort of the employment and issues around that that you see?
No, I mean, it's really difficult. I mean, I think it's case by case. I mean, clearly, when we're in a situation where not enabling the access to the PPP, we've then, we're faced with, okay, then if we can't support people, and we have to lay them off, then that's kind of why we're trying whatever we can to try and backstop whatever would have been lost through us being able to support. We are looking at headcount. We are encouraging folks to do what they can. We are working with each of our boards on cost-cutting measures, whether that's directly related to people or whether it's related to projects or OPEX. I don't think there's a golden rule. I mean, I think you just have to take a very detailed, thorough approach to helping your portfolio companies navigate. It's never easy when you're talking about layoffs or furloughs or pay cuts, and I think it's just it's being sensible, being pragmatic, and trying to do the right thing.
Really
as easy as that all sounds.
I imagine a lot of work, a lot of conversations, a lot of just difficult decisions being done at this time. So really appreciate Mac and Mark, giving such a sort of, holistic overview. As you say, there's a lot more slides and detail that you have both on your website and through this presentation, which will be available for attendees afterwards. And David, obviously, really appreciate you bringing some of the sort of the from the coal face type of analysis. Any final thoughts or views from DLA, Mark, Mac, and then from David?
Well, I would say that this is a very dynamic area and that people need to keep track of what is going on. I think it's fair to say that we can expect more government relief. And as a matter of fact, one of the things we published last week was a guide to government programs, not just in the US, but overseas, because many other governments have similar programs. And so I think the key here is you need to be aware of them. And I also think that, as you take a look at the programs, you need to think about the larger business issues. But just as I've said, we've seen this sort of shift from wow to wow, but look at the strings or the reputational risk. So I think it's critical that people be aware of the fact that this is going to be very dynamic, and you should be prepared for the fact that things are going to change. Mac, you may have some thoughts about what we're going to see.
I agree with all of that, and I also agree about the risk, the reputational risk issue. Just one other thing in the legislation, but there are oversight provisions, and the House of Representatives has indicated that they will create an oversight committee to look at the way in which money is being used. So that's one more area where these issues could come up. Looking forward, while the timing of further funding for the PPP program and whether there will be additional limitations put on the use of that is a bit unclear. There is an expectation that there will be at least 2, maybe 3 more rounds of legislation focused on substantial stimulus measures. There's the expectation that there will be both a tax bill that will be both focused on stimulus questions as well as dealing with some other underlying tax matters that have been pending for a long time. And actually policymakers are looking for input on what should be included in those packages. There's talk about a large infrastructure program that would be very broadly defined, and many of the leaders who've been pushing for that talk about the importance of highlighting technology infrastructure in addition to physical infrastructure. And there's an expectation that there will be more direct assistance of the kind that's in the CARES Act, but perhaps more targeted to some of the areas where it has been perceived as not having gotten to yet and that are in the greatest need. So there's lots of legislative activity coming. Congress is not scheduled to be back until early May, but the process continues behind the scenes and on an ongoing basis.
David.
No, I mean, I think just to highlight the point, I mean, this is very much an evolving conversation. I mean, this all took us a little bit by surprise maybe 2 weeks ago, but we moved to a position quite quickly, and we're holding to it. But that being said, if new information comes out, or if a different stimulus comes out with a different set of rules, maybe a softening of the affiliate rule, and maybe is more specific to those technology companies and venture capital backed companies, then our position may flex to to fit. So I think it's kind of a case of watch this space and continue to keep up to date with what's going on.
Well, definitely, there's no better people to do that than all three of you. So thank you very much for that. And on behalf of Global Corporate Venturing, appreciate your time, appreciate the listeners. We've had a few audio difficulties. I think for some of the people trying to listen in, they couldn't get the link work. It seemed fine. We have a recording, so we will send out the recording with the slides to all those who registered. If there are follow-up questions for any of the three, we'll pass them on. But also from Global Corporate Venturing's point of view, we'll keep on top of this situation as best we can from a global perspective. I'm mindful that this presentation and discussion was primarily focused at the US for obvious reasons as the largest venture ecosystem. But we will do and cover the sort of the global context on behalf of the partners. And as Kalyan is helpfully reminding us, do take a look at the survey as well. And thank you very much to Kalyan for setting this up. Thank you all.
Thank you, and stay safe, everyone. Goodbye.
Thank you very much.